this video, I will be reviewing what has happened and what might be predicted to happen for the second half of 2023. Welcome, and I'm so glad to have you join us here today. Can you believe it? It's almost the middle of June. Hi, I'm Tom Olsewski with Team Olsewski and eXp Realty. We're really approaching the midpoint of the year, and it's been quite a year. Just looking back at where we were in January, right? We had an interesting winter. Parts of the country got lots of snow and rain. Other parts of the really mild winter with not enough snow. And here it is almost the start of summer with the summer solstice right around the corner next week. And more importantly for us, when we look at the real estate markets this year, what an incredible turnaround, right? We started at the beginning of the year with a wide range of forecasts of what the real estate market would be just given what happened last year, right? As you may remember, last year we had quite a ride, right? Mortgage rates shot up, more than doubled, prices reached their peak. And so at the beginning of the year, you may remember, we had all kinds of predictions, from fairly upbeat ones all the way to dire ones. I have to say, looking at the real estate market here, it's a far cry from the concerns that a lot of people had in the beginning of the year. It's in a sense quite lively. We're seeing lots of buyers out there, and it's a really tight market given the limited inventory. Excuse me. I will have some slides that I will pop in to show you. We are at the midpoint of the year, and we're trying to take stock at what has happened in the market. And you know, generally, the big question is, why are we looking at prices right now, right? In a sense, the price is not really a driver of the market, yet it is, right? It tends to be a signal. What's the balance between supply? How many homes are available for sale? And where's the demand at? How many buyers do we have in the market? And traditionally, the more buyers and the fewer homes, as we're seeing in today's market, not only here across the country, prices tend to rise. The flip side of that coin is fewer buyers, more homes on the market. We tend to see prices lagging. And so this year in particular, I think it's useful for us to take a look at what prices are doing, because we seem to be at one of those inflection points where there are contradictory signals in the market, and expectations, forecasts muddied the waters, and of course headlines didn't help as much. You need to stop with the headlines. So with that in mind, here's the big question for me, and I think for so many of us in the market. What is happening with home prices, specifically now that we are approaching the tail end of June? And as you may remember, last year June, so pick prices as we come around this 1 year lap. If you watch my last Riverside County real estate market update, I reviewed what's going on with regards to activity here and where a home is priced. What is happening with home prices, and what is that telling us about the markets? And to kind of capture that and give us a little focus, I found this quote from Ali Wolf at Zonda, which is particularly enlightening in the sense what she's saying about the market, right? It's really challenging to time the market specifically. And in her case, she's got the lens of the new home construction side. But what she says next in that sentence, I think it applies throughout really the economy and the housing market. We need to try to block out headline noise and stay focused on long-term trends. And the key here, I think, is that headline noise. And I say that because June of last year was the first time we saw roughly 2 quarters of decline in the economy as measured by gross domestic products. That's typically a sign of recession. And that's when headlines really ramped up and started to say, we're in a recession, or we're not in a recession, but a really tremendously bad recession is about to come. There's a recession around the corner. Housing's going to crash. Prices are going to crash. Well, so many headlines were driving home this idea that the Fed, though, its monetary tightening was going to drive both the economy and the housing into a deep recession, and we should be prepared for that. And yet, month after month after month, I was looking at the incoming economic and housing data, and there wasn't quite as much dire emergency in that from a recession and the economy tanking. So let's put some perspective on home prices. And what I have here just for trend, like we're talking long-term trends, as Ali highlighted, I have Realtor.com's listing price. Generally, a lot of you consumers, when you first come to the market, you log into a portal and these are the prices you tend to see. This is your first sense of the market. And yet, as we know as practitioners, asking prices are just that, asking prices. They can, depending on the market, be too high. And generally, as you know, there will be a discount from asking price. Historically, that discount was somewhere in the 3 to 5% in a healthy market. At the same time, as we've seen in the last 3 years, asking price can just be a starting point in a bidding war, right? For a lot of buyers over the last few years, the asking price was just the floor, and then bids went over that asking price. And so the closing sale price, in a sense, much higher. I'm only using this price as really a starting point to highlight the fact that June of 2022, we saw an all-time peak in listing prices. And so as we go through the following 12 months, so much of what we've been comparing when we look year over year, month over month, we're comparing to those peak periods, right? Peak, keyword. And what we've been calling the unicorn years of real estate markets in the last cycle. And so I think this is relevant because anytime you compare something either to a really low baseline, think about this, you go from 1 to 2, it's a 1 unit change, but it's a 100% shift. If you go from 100 to 101 again, 1 unit shift, and yet it's only a 1% change, right? So whenever we look at minimums and maximums, changes can really sometimes be misleading. So with that, what happened after the peak? Well, we saw mortgage rates go up during the June through November peak, where they shot up over 7%. Not surprisingly, listing prices combined 2 factors. One, we had mortgage rates impact demand, but 2, and more importantly, at the same time, seasonality. You know, spring, summer, we see lots of activity, prices tend to ramp up, and then come fall and winter, prices tend to retreat or stay flat. During this period is when we saw all those headlines basically say, well, the market is crashing, we're going to see a massive price correction, and we're going to see a housing market. People were comparing to 2008 and 2009. And yet, when you look at 2023, the green bars on this chart, you see that the prices are telling a slightly different story. And so here I have highlighted for you January 2023. So this year, listing prices compared to January 2022, what do you see on a month-over-month basis, right? You compare listing prices from December to those in January. They were actually up about 3%, and even year over year they were up about 1%. So in a sense, prices didn't really crash the way the media had portrayed. We are in the market every day. We see the fundamentals. We've been seeing the tightness in the inventory. We've been seeing buyers, especially now that we've had roughly 8 to 9 months of mortgage rates moving in a fairly narrow band between 6 to 7%. Buyers have moved beyond the shock of mortgage rates are so much higher to the, well, these mortgage rates are here to stay. With the 50-year mortgage rate average at about 6%, that makes sense. So buyers are asking, how do we navigate this? And so knowing that listing prices also reflect the mix of homes in the market. We've seen this some months. You have a lot of high-end luxury homes come to the market, particularly in sunny states. Think winter, Florida, California, Arizona. Lots of buyers flock to buy homes in other months. The mix of homes may be skewed more towards the lower price. You might know this if you've watched my Riverside County real estate market update recently for May. All of that can have an impact on prices. And that listing price mix of homes problem also impacts medium sale prices, as you well know. So when we are looking at prices, and I know you do this on a daily basis, how do we analyze prices? That's what we do. We try to stick with repeat sales pricing indices. The best known of them is obviously the Case-Shiller, but several other organizations or Logic, Black Knight, Federal Housing Finance Agency, the overseer for Fannie and Freddie, they have all replicated Case-Shiller's methodology in looking at the same home trading hands time after time to really capture the change in value, right? Because that home that sold for a few years ago for $100,000 sells for $110,000, it's the same home basically, and we know that those prices represent the 10% increased value. And so when we look at the price changes, we take two approaches. One is to look month over month, mostly because month over month really gives us momentum indicators, particularly in volatile markets like we've been having. When you're going from a peak market on a lower trajectory, or when you've hit bottom and you're about to turn, the month over month reading gives you a nice quick view, especially when you have 2 or 3 or 4 months of that. It shows you momentum changing, either market picking up or market slowing down year over year. On the other hand, it's really helpful in a stable, steady market because it removes some of the seasonal volatility, right? Higher activity in the spring, summer, lower activity, fall, winter. And it gives you a sense of trend. So putting those two together, you have a much, much better, more nuanced picture of the market. And key to that, when we look at home prices of a long enough period of time, what stands out is the fact that they tend to reflect demographics, the economy, and market fundamentals. What we see here really are, this is from the Case-Shiller Index, home prices over a 1-year, 3-year, 5-year, and 10-year period. And you can tell, even with the dire predictions of the last year, home prices are still in the positive. And so I think for a lot of buyers, the reason I say this, for a lot of the buyers who are worried this year about their, number one, prospects for finding a home, number two, whether it even makes sense to even buy a home in 2023. I think it's important to help buyers understand that a long enough time horizon is really beneficial for a lot of folks who are in the right position financially from a job standpoint and a life stage to move forward with it and buy. So looking at that month-over-month momentum, and then we'll compare some year-over-year numbers. What do we see? These are the latest numbers, and this is Freddie Mac, who also produces a home price index that looks at repeat sales approach. So same home trading over time. You see here the slowdown from last summer, roughly in June, when prices really took a step back. They still rose in June, but they took a step back. You saw the impact of the second half of last year from mortgage rates, from headlines, really instilling a lot of concern for buyers and sellers in the trajectory of the market. And then you see this rebound, January, February, March, April. We've seen solid, steady rebound in prices. Same picture with slightly different numbers for Black Knight. Same mythology, see the same second half of the year softening and the rebound in the first 4 months of this year. And I think this was such a nice way that the Black Knight's report captured it. They basically said, we're comparing home prices to a year ago, and so in a sense you might see variation, possibly even slight decline. But Black Knight's view is at the current trajectory, annual home price growth would only fall modestly below 0% for a very short time before pulling back above water by late second quarter. So towards where we are, or early third quarter, key here, and I think this is worth highlighting, firming prices nationally have erased more than 60% of price declines from late last year, and they're really on track to recover by mid-year. Not surprising to us, I know, because we're looking at market fundamentals. We know that inventory, even though active inventory has been growing compared to last year, still remains tight in some markets. We're actually still seeing multiple bids this season. Southwest Riverside County is one of those markets where for some buyers it's been a surprising market. You know, they're going to the market, they're finding more homes to choose from than when they go to put an offer in. They're finding they're not alone. They're dealing with other competitors. There are several other buyers in competition for the home. Same situation we are seeing in CoreLogic's home price index, where you see the second half of the year softening and then a nice strong rebound in the first 4 months of this year. So you're beginning to see now multiple sources showing the same improving picture in the market, which is basically illustrating that for all intents and purposes, buyers are ready to move forward. And I know for a lot of sellers, the concern and fear of a lack of buyers has been holding them back. I hope that these numbers will give them encouragement. And here's what really, absolutely, I found so fascinating. Thelma Head, chief economist at CoreLogic, in the latest pricing report, hired the fact that at the recent trends, just that home price growth this year, 2023, will fall in line with the historical annual average of about 4%. Just to take a quick step back, in December of last year, a lot of organizations released their forecasts for home prices this year, and what stood out? They were basically, two organizations, Realtor.com, CoreLogic, that forecasted prices to be positive this year to the tune of roughly, 3 to 5%. And a lot of organizations forecasting prices to drop, some of them quite sharply. And in a sense, some of the forecasters who are positive or rated as confident may be having their rose-tinted glasses. Well, it turns out so far the market tends to show that maybe the folks that saw the market dynamics, supply and demand balance driving this year might have been right. But we're only at the halfway point this year so far. So let's keep an eye out. Now, looking specifically by markets, I think this is such an important distinction. I want to highlight for you today, when you look at the top 20 metros that Case-Shiller tracks, what you see here, and this is the latest data, which is March, you see half of those top 20 in March had year-over-year lower prices. And when you look at which markets those were, primarily they were Seattle, San Francisco, San Diego, Portland, Phoenix, all West Coast markets, which were already at record high prices and which have also seen over the last several months a real slowdown in tech sector employment. What's interesting, however, about these markets, when you look at more recent month-over-month trends, and I'll switch the slide so you pay attention to this, you will see the color change. When you look at month-over-month, all of a sudden, you're only seeing about 5 of the 20 markets seeing price declines. In fact, recent price momentum showing even San Francisco picking up. Just to highlight it again, here's the year-over-year picture. Half the markets are in a negative territory. Here's the month-over-month. Clearly, as we moved into spring, even some of these markets, buyers returned, and we're seeing a lot more traction in these markets. And in fact, this year-over-year, month-over-month distinction really comes into a clearer view when you put them side by side. For some of those metros, you can tell that compared to a year ago, in a lot of these markets, prices were lower at the same time, on a month-to-month in March. And since March, we saw CoreLogic, Freddie Mac, we saw these continue with that positive momentum expectation. Case-Shiller will show that too when they come out with the April data. And you see the recent price momentum is picking up again, encouraging. It's an encouraging sign of a market, as you would expect. The point I'm trying to drive home is 2023 is already looking a lot more like a typical housing market, unlike the unicorn years of 2020, 21, 22, which were anything but a balanced market. And so when we put a map view on this right picture of being worth 1,000 words, here's the year-over-year change in home prices. This is quarterly from Fellow Housing Finance Agency. And again, what you see here distinctively is Pacific and Mountain states, those which were already challenged by affordability concerns and which have also had a bigger squeeze on the tech sector employment, have seen sharper changes in prices. The rest of the country is really on solid footing. Moreover, when you take that picture and lengthen the time horizon, you can tell that even for those West Coast markets, by and large, homeowners are sitting on an incredible amount of equity given home values over the last 5 years, which is one of the reasons whenever people ask me, should I buy a home? And I get this question quite often, should I buy a home? Generally, my question back before I answer is, how long do you plan to live in this home? How long do you plan to be in your job and in the community? If you plan to be there 3 to 5 years, this might be as good a time as any to buy a home. If you plan to be there less, whether you think you're going to move, your job is not secure, you don't have all the financial ducks in a row, then you might want to wait. You can tell over long enough time horizon. For most homeowners across the country, it's been an incredible 5 years. So with that, I want to just highlight for you what's for us on a sort of a looking glass for the week ahead. It's going to be a very interesting week from the data perspective. Number one, the consumer price index is coming out, so will be one of the principal measures of inflation. We're going to see what's happening with consumer prices. Number two, the Federal Reserve, the Federal Open Markets Committee, the rate setting committee is meeting, and they are finally going to stop raising the rates. They're talking 2 more at the end of the year, but if things look good, who knows? That will have repercussions through the economy and capital markets. We'll keep a close eye and keep you in the loop. Number 3, retail sales give us a read on the health of consumers. And number 4, mortgage rates. We've seen them pull back a little bit in the wake of the debt ceiling resolution. So it'll be interesting to see what this week's mortgage rates will look like. So thanks for watching, and I hope this information has been helpful.